Hi everybody, welcome to our channel once again. Today I am going to start with a new subject, revision of corporate and management accounts. Okay, this is again your MCQ paper module, your MCQ paper this is for module 2 and also very important subject. Okay, why? Because it is very scoring. Okay, here this subject is scoring because again one thing, it is MCQ. There is also a lot of theory which you all can attempt, and there are practical questions. Okay, so I'm going to cover all the important topics, okay, which you can refer, and all the exam questions, okay, from topic wise. So today I'm going to begin with an important chapter, which is accounting for share capital. Okay, so I'm Fatema Kagalwala, for all of you all to know. I have, I'm in love with this particular subject. Okay, I love teaching accounts, and I love this account subject, and I have also scored very well. During my time, it was a proper written paper. Okay, and you can easily get exemptions in these MCQ papers, the practical ones. Okay, if you will study strategically and study important. Okay, whatever is important, you clear your concepts and then apply. It is going to help you a lot. Okay, so here I'm going to take you all through all the past exam questions, and for your better understanding, I have split the chapter. I have made parts of this entire big chapter. If you will see your module, this chapter number 3, accounting for share capital, it is a vast chapter. It is the lengthiest chapter in the paper, in your book. Why? Because it has got a lot of things. It has got parts in it. Okay, it talks about issue, it talks about right shares, bonus shares, it talks about buyback, it talks about preference shares. Everything is included in that particular chapter. To make it easy, okay, I have split that entire chapter in parts. So I'm going to cover all those parts because it is a very important chapter of your part A of corporate accounts. Okay, you know that a paper, corporate and management accounts, is divided in two parts, part A and part B. Okay, so part A, chapter 3, it is a very important chapter. We will be solving the past exam questions, all the most important past exam questions, and the probable questions which can be asked. Okay, I'm going to solve that all with you all. So everything will get covered. You will, with the past exam questions, you'll get an idea that how important this particular chapter is. Okay, so we are going to solve all of that. So let's begin. Okay, let's go ahead with our subject. Okay, so since I am talking to you all about accounting for shares, okay, and that accounting for shares includes a lot of subtopics, I have selected today to go ahead with part A, which is issue of shares. Okay, I'm going to do 3 parts with you. I'm going to do issue of shares, I'm going to do right and bonus shares, and also buyback. Okay, so all the 3 parts we are going to cover today, and then some of it I am going to take it again in the next class. But as of now, we have to concentrate on issue of shares as part A. Okay, this has to be very strong. Issue of shares, each and every concept has to be very strong. Okay, so let's begin. Now, what we all know, what is issue of shares? Okay, right? We all know issue of shares means we are talking about from the company point of view. When company, okay, issues shares to public, okay, for subscription. Why do they issue this? In order to raise capital, okay, in need of capital. So in order to raise capital, company issues shares to the public. Okay, now this issue of shares, if you see broadly speaking, issue of shares, okay, all this is important from your theory point of view also. Okay, so if I say issue of shares can be of, broadly speaking, for 2 types. Either it can be for cash, or it can be for consideration other than cash. Okay, for consideration other than cash means in this particular second thing, consideration other than cash. In that case, the shares are issued, but not for the purpose of collecting cash from that particular issue. Okay, there is no cash involvement. There is nothing which is received by the company. Okay, for consideration other than cash, sometimes the shares are issued to the promoters. Why to the promoters? Because for all the expenses or for all the work, okay, which they might have done, okay, for the purpose of running the company or starting the company. So in order to give them, and it is rewarded to them, it is given to the promoters for not for free, but obviously for all the work which they have done. Instead of paying them, we make them the owners of the company by giving them the share. Okay, so companies sometimes issue shares to the promoters. Okay, so that can be one way. Generally, whenever shares are issued to the promoters, the companies they debit that particular expense to goodwill account or preliminary expenses account, because it is an expense to the company. Company is giving shares but not taking anything in return. Second, we can also issue shares to vendors. Now, if I want to buy a plant and machinery and I'm a new company, okay, I may not have that much of cash as of now in order to buy that plant and machinery. So I can tell my vendor that you provide me with plant and machinery, and instead of I paying you cash, I will give you some shares of my company. Okay, so that also can be a possibility, consideration for other than cash. And also to purchase an entire business. For purchasing, sometimes purchase of businesses, obviously you have to give them the shares. And it can also be given as a sweat equity shares where there is no money taken. Okay, there is no money taken from the employee. Sweat equity shares generally issued to employees. Okay, so there are these are the ones in which consideration other than cash is there for issue of shares. But we have to focus more on for cash. Okay, so when shares are issued for cash, it can be issued at par, it can be issued at premium. Okay, as per 1956 Act, they could be issued even at discount, but now it is not there as per 2013 Act. Okay, shares cannot be issued at discount. It cannot be issued unless okay, it is either given to employees, okay, either given to employees, or it is given, or it is reissued as forfeited shares. Reissue of forfeited shares. Now all these terms, what is forfeiture, what is reissue, everything I'm going to make you understand. There is nothing to worry. Okay. So shares may at par and at premium. What is at par and what is at premium? Shares always have a face value. Okay. So say my face value is rupees 10. But when I am issuing it to public, okay, my issue price is there. I can decide my issue price. So my issue price is also say rupees 10. So I can say my issue is at par. The face value is the same as my issue price. Okay. But for premium, the face value is rupees 10. But when I am issuing to public, I am issuing at my premium. I am issuing my shares at a premium amount. I am taking rupees 12 from public. So here my issue price is greater than my face value. Therefore, I will say that the issue is at a premium of rupees 2. Okay. When the company collects more money than the face value, issue is said to be at a premium. Okay. So this is the first most important concept in issue of shares. Issue of shares for cash. It can be at par, at premium. It can be at discount only if it is given to employees and if it is given as a reissue of forfeited shares. We will come to reissue of forfeited shares. Okay, and for consideration other than cash, it can be given to promoters, vendors, purchase of business, sweat equity shares to employees. Okay, so this is your first most important part on issue of shares. Now coming to second. So what is a face value? What is an issue price? What is at par? What is at premium? Okay, all that is we have to understand. Now there is second thing. Okay, whenever shares are issued, two things can happen, or I'll say more, not two things, three things can happen. Okay, say suppose company has issued 1000 shares. Okay, so the entire issue is fully subscribed, total, fully. I got the buyers of all that 1000 shares. Company removed 1000 shares for issue and entire 1000, exact 1000 shares have been subscribed by the public. So fully subscribed, right? Second thing, it can be undersubscribed. Company had removed 1000 shares, but subscription was received only of 800 shares. Now, as per Companies Act, if the subscription is less than 90%, minimum subscription we require is 90%. Minimum. 90% of subscription. If not received, we have to refund the entire money, application money. So here, if 800 shares have been received, I will have to refund it. My entire issue will fail. That is why all these companies have started appointing underwriters. So that underwriters are the one, okay, who will take up the liability of the unsubscribed shares. So whatever is remaining, it is unsubscribed by the public, underwriters will take it up. They charge commission for the work they do. Okay, so they will take up the shares so that your issue does not fail. So we have to also cover underwriting. That also we will cover. Okay, I am definitely going to teach you all underwriting. How does underwriting work? Okay, how to find the liability of the underwriters. And the last one is oversubscription. Oversubscription. Your company had removed 1000 shares, but I received application of 1500 shares. Oversubscribed by 500 shares. Imagine in the college, the seats are only 100. Can the college give admission to 150 students? Not possible, right? Similarly, company has only issued 1000 shares, but they are receiving application for 500 more shares. They have received application for 1500 shares. So two things company can do. Okay, they have a choice. Either they refund this entire 500 shares, refund the application money for this extra 500 shares, or what they can do is they can do allotment on pro rata basis. Allotment on pro rata basis. Pro rata means what? Say for example, I had 1500 shares application is received, but allotment can be done only as per 1000 shares. Okay, this is application, but allotment can be done only as per 1000 shares. So my ratio will become 15:10. So if anybody has applied for 15 shares, I'll tell them I'll not give you 15, but I'll give you 10. Okay, so refund does not happen. Pro rata adjustments are taken place. This is a very, very important concept from your MCQ point of view. Almost all the sums are based on this. Okay, receiving extra money on the case of application, adjusting them in the case of allotment, or refunding them again back at the time of application itself. Okay, so this is one very important factor which you all have to understand. We will solve the exam questions, you will get a practice. Okay, at one go you may not understand how it is refunded or how it is adjusted, but the more sums, I'm going to solve all those sums with you all. So once we will solve that, you will get a practice. Any sum koi bhi sum rehne do, any sum which is there in your exam, you will be able to solve it on this over subscription. Okay, so this is one second part of issue of shares. Important. First and second we have done. Now coming to the third one. Third part. Okay. Now understanding the accounting treatment. Accounting treatment for issue of shares. Issue of shares. Now when it was a proper writing paper, obviously all the journal entries had to be passed. Okay. But now also I am going to teach you all how the accounting treatment happens, because in the MCQs they might ask you a journal entry effect, debit credit effect. Okay, then the students get confused because they have not practiced the sums as a whole sum together. Okay, so practicing of journal entries, knowing the journal entries is also very important. Okay, so accounting treatment for issue of shares, I'm showing all the journal entries, what has to be debited, what has to be credited in the entire process from application till final call. Okay, so let's begin. Now this is the most important section, okay, of issue of shares. Now say for example, just write down an example. Say a company is issues 200 shares. No, right, issues 100 shares. Easy for us to solve. Issues 100 shares of rupees 10 each at par. Okay, the money is collected in this manner. Okay, money is collected in this manner. Application stage, when you will go and apply for the shares, at that time you have to pay rupees 2. At the stage of allotment, company is going to collect rupees 3. On first call, again rupees 2, and on final call, rupees 3. Okay, not necessary, no, the company may not need all the money as of now only, this entire 10 rupees. They might just need 5 rupees currently. So at the time of allotment, application is received, company is going to allot you shares, at that time you pay 3 rupees, 5 rupees is being called. Then eventually company may call for another 2 rupees, another 3 rupees, so on and so forth. Okay, so this is how the payment structure is there on issue of shares. Okay, application stage, allotment, first call, final call. So we have 4 stages. Okay, stage 1, stage 2, which is allotment, stage 3 is first call, stage 4 is final call. Now it all depends upon the company. Sometimes they might just do first and final call, finish. So these 2 stages are done in one thing. Okay, application and allotment, entire money might be only application stage is there. Application and allotment stage is only there. There is nothing which is like first call, final call. Entire money is received at the time of allotment and it is over. Okay, but we will see the accounting treatment for all the 4 stages. Okay, so say in the books of ABC Limited, in the books of ABC Limited. Okay, I'm going to solve the sum. So I'm starting with the application stage. Okay, first one, application stage. For the application stage, I will start with the receipt entry. Why? Because I'm going to receive the money. So from company point of view, bank account debit. Okay, bank account debit to share application. To share application account. How many shares are there? 100. I am going to receive 2 rupees at the application stage. So 200. Correct? I have already passed my receipt entry. Each stage will have 2 entries. One will be receipt entry, one will be the transfer entry. Okay, each stage. Only at the application stage we pass the receipt entry first and then the transfer entry. But in all the other stages we will first do the transfer and then the receipt. First we will transfer and then the receipt. Transfer and receipt. Okay. So I have already passed my receipt entry for application stage. Now I am passing my transfer entry. Transfer entry means what? I am going to transfer my share application to equity share capital account. Issue of shares. Okay. So share application account debit. How much it is? 200. To equity share capital account. Being the share application money transferred to equity share capital, 200 rupees. My first stage is over. Okay, my first stage is here over. Always remember one thing, that whenever you are recording equity share capital is always recorded at face value. Okay, write that down in a corner like how I have written. Always equity share capital is always recorded at the face value. Okay, so face value on application money is 2. Okay, 2 into 100. I am telling all this why? Because say if tomorrow shares are issued at premium or issued at discount, reissue at discount, then what will happen? So remember this one thing, equity share capital always at face value. So even in the exam MCQs are asked, or how much amount is equity share capital debited or credited. You should always know that whatever you are taking, number of shares you are taking, are multiplying by the face value of that particular share. Okay. Next one. I am going to my allotment stage. I am going to receive 3 rupees. Fine. So first I will pass the transfer entry. What will be the transfer entry? Share allotment account debit. There are 100 shares on which 3 rupees are supposed to be received. Okay, though not received currently, but I am going to transfer to equity share capital. Okay, at the time of the receipt, now I will pass the receipt entry, which will say as bank account debit 300 to share allotment account 300 rupees. Okay, so second stage is done. This is the way it is to be passed. These are the rules of passing the journal entry. Okay, because application is done today, allotment may be after 15 days, 10 days, etc. Then the first call may be after some days. So dates keep changing here. Okay, transfer takes place and on the date of receipt we will write the receipt. Okay, now next is my first call. First call rupees 2 I am going to receive. So I am going to pass my transfer entry here. Okay, transfer entry, share first call. Write down, share first call. Share first call account debit to equity share capital account. On 100 shares, my call money, first call money is rupees 2. So by 200. And then at the time of receipt, my sixth journal entry will be bank account debit 300 rupees, 200 rupees to share first call account 200. Okay, so I am done with my first call stage. Now the last one, final call. Same thing again. Transfer entry, share final call, share final call account debit. I'm going to receive 3 rupees. So by 300 to equity share capital. Okay. And then receipt entry, which will be the last entry. It will be bank account debit to share final call account. 300. Okay, so in any given stage, these 4 stages, if it is there will be these 8 journal entries. If there are only 3 stages, first and final call, my journal entries will stop at the 6th one. Okay, finish, over. 6 journal entries. Each stage is having 2 journal entries. Okay, one is of the receipt and it is of the transfer. Now I am changing my example. Okay, I am changing my example. I am saying that the company issues 100 shares of rupees 10 each at a premium. Okay, so here, so this was your first one. Now the second one, it is issuing at premium of rupees 2. Okay, collected at the allotment stage. Okay, rupees 2 premium. Generally, premium is always collected at the allotment stage unless otherwise specified that it is taken at the time of application. Okay, so now this rupees 2, I am going to get it at the allotment stage, extra premium. So my issue price is going to be rupees 12. Okay, so in my second case, my issue price will be 12 rupees and face value is going to be 10 rupees. Okay, clear? So now what happens is, application stage, there is nothing to worry about. 100 shares pe I am going to get 2 rupees. Bank account debit to share application and share application to equity share capital. Application stage is nothing to worry. What I have to change now in my example is my allotment stage. Okay, at the time of allotment stage, security premium, this is the share premium which I am taking. Okay, so it is always recorded at the transfer entry. Okay, so you all can see the transfer entry here of the allotment stage. So share allotment account debit, if you see the total amount on share allotment is going to be rupees 5. So I will also have to debit it by I will have to debit this by 100 shares into 5. 500 rupees is there at the time of allotment, which is supposed to be received at the time of allotment. But equity share capital is always recorded at face value. So what will I do? I will do 100 into 3 only. Because at the face value I am collecting only 3 rupees. This is the premium. This is the premium. Face value is 3 rupees. So I am going to debit this by 300. Sorry, credited by 300. So the premium amount which I have received, it will be transferred to security premium account. How much premium I am receiving? 100 rupees into 2. 200 rupees I am receiving as a premium. The company is going to get the premium of 200 rupees. They are going to put that in the securities premium account. Okay. So note down one thing, that whenever there is a premium, okay, or in that case there could have been a discount. Discount I will show you all at the time of reissue only. So whenever there is a security premium, it is always recorded as the transfer entry. Okay, so security premium is always recorded at transfer entry. Always. Okay, so at the transfer entry only securities premium will be recorded. Done. This was my second example. Okay, now I am just changing a little bit more to this example. Now I am saying, say now for example, next one, third one. Same question, okay. We are in the books of ABC only. First one was at par, at premium we have understood. Now the third one I am saying, Mr. X holding 50 shares failed to pay first call and final call. Okay. So now this person, Mr. X, he is having 50 shares. The directors are making call money, but he is not paying me my first call. He is not paying the company his final call. So now what will happen? So here, until the allotment, everything will remain the same. Okay. Until the allotment year, everything will remain the same. I am just changing my first call and final call journal entries. Even in that, nothing changes. Only a little bit of change here and there you have to do. What is that? Okay, so I am going to change my first call. Now what has happened is, I have already transferred share first call account debit to equity share capital on 100 shares. I have already transferred 200 rupees. But what happened at the time when I received the first call? In the bank, I got money only on 50 shares. Mr. X holding 50 shares did not pay me. So I got on 50 shares, I got 2 rupees. So now this is going to become 100. This is going to become, in bank I received only 100. But share first call is 200 now. In the case of receipt, the first call is 200. So now what will happen is, calls in arrears. Calls in arrears. Calls in arrears means amount not received by the company on some shares. So calls in arrears are also on 50 shares. We have not received 2 rupees. So here it will be 200. To share first call account. Share first call account 200 rupees. Okay, I hope you all have understood this. So whenever there is calls in arrears, or in that matter that can be calls in advance. Okay, some people pay in advance only. During the time of the allotment only they pay first call, final call also. Very rare cases, but sometimes members do that. Okay. Now what has happened here is, there was calls in arrears. That calls in arrears, the company will come to know when the payment is done. Therefore, calls in arrears is always recorded in the receipt entry. Always. Okay, so calls in arrears is always recorded in receipt entry. Alright, clear here. Now what happened is, I came to my final call. I transferred from share final call account debit to equity share capital. Transfer is already done. But what happened is, when the time of payment came, okay, when the time of payment came, in the bank, I received money only on 50 shares. 150 rupees. Why? Because there was a calls in arrears. Mr. X did not pay me. He is having 50 shares. He did not pay me my 150 rupees. To share final call 300. So you see, calls in arrears is always recorded on at the time when we pass the receipt entry. Now this Mr. X, he is not paying. So now since he is not paying, what have the directors decided? They have decided to forfeit his shares. Okay. So now the fourth example. Mr. X shares are forfeited. Means the company is going to cancel his name from the books. Cancel those shares, equity share capital. Okay, cancel those 50 shares. Okay, so shares are going to get forfeited. Now, what happens when the forfeiture is done? There is another journal entry to be passed. So, until the final call, everything is over. Now, I go one step forward. I pass my 9th journal entry, which is of share forfeiture. Share forfeiture. In the share forfeiture, I am cancelling the shares. When I was receiving the shares, I was crediting equity share capital. But when I'm going to cancel it, I'll debit the equity share capital. Okay, so here it will be equity share capital account debit. How many shares? 50. What is the face value of that share? 50 shares is 10 rupees. Face value, always equity share capital, always at face value. So here it is going to be 500 rupees. 2. Calls in arrears. Calls in arrears is always the unpaid amount on shares. Unpaid amount. How much did Mr. X not pay me? He did not pay me my first call and final call. So on shares, my unpaid amount is 5 rupees total. Right? So calls in arrears, 2 calls in arrears, 50 shares into, we will do 5 rupees. 250. So see, I'll just cross check that with my calls in arrears. There is calls in arrears in my journal entry number 8, 150, debited. And it is also there in my journal entry number 6, 100. 100 plus 150, 250. So I had debited calls in arrears. Now I am crediting calls in arrears to remove this shares completely. Okay. So 2 calls in arrears. And the amount which I have got already received, I am not going to refund it to Mr. X. Okay. I will transfer that amount to share forfeiture account. So share forfeiture is always on the paid amount. Paid amount on face value. So how much he has paid me? Mr. X has paid me on 50 shares. On 50 shares, he paid me my application money. He paid me my allotment money. 5 rupees. He's also paid me my securities premium. But share forfeiture is also always recorded at face value. You cannot take the security premium here. Okay. Also security premium is paid now. So some of you will be having that ma'am, he paid application to allotment mein he paid 2 year. He has paid 2 on application 3 on allotment, but he has also paid no this 2 rupees. So share forfeiture should also reflect this. No. If securities premium is paid, okay, write down the note if you all want to. If securities premium, okay, security premium is paid, then it is never recorded in forfeiture entry. Never. If it is unpaid only, then I will come to that also. I will also change this example and come to forfeiture of when the securities premium was unpaid. Okay. So if it is paid, then it is never recorded, and share forfeiture is always recorded at the face value. Okay. So this was example number 4. Now coming to example number 5. Say suppose Mr. X paid me my application money. Then allotment pay 3 plus 2 premium is there, no? first call, final call. Okay. Mr. X paid only application money. Then from allotment, he has not paid me allotment money. He did not pay me my first call. He did not pay me my final call. Okay, so all this is unpaid. Only this is paid. I'm not changing all the previous journal entries now. I am showing you all the share forfeiture entry. Okay, so Mr. X did not pay me, failed to pay allotment money, first call money and final call money on 50 shares. Okay, and then his shares were forfeited. And now I'm saying his shares are going to get forfeited. Okay, so now what will be the journal entry? Share forfeiture. That ninth journal entry is going to change a little bit. So here, equity share capital account debit. I'm going to cancel his 50 shares. Face value of the share is 10 rupees, 500. Mr. X has also failed to pay me this security premium. So now, since I have not received it, if I would have received, when I was receiving, I was crediting my security premium account. Since now I have not received it, I will debit it. Security premium account debit. On 50 shares, I have not received rupees 2. Okay. 2 calls in arrears. Calls in arrears. Calls in arrears is always on the unpaid amount. Total unpaid amount. Total. So unpaid amount total is how much? It is 3 plus 2 plus 3 plus this 2 also. So 3 plus 3, 6, 7, 8, 9, 10. So total unpaid is 10 rupees. So calls in arrears will now be on 50 shares. It will be 10 rupees. To share forfeiture account, always on the paid amount. Paid amount on face value. Now how much is the paid amount on the face value? 2 rupees. So I will debit this 50 into credit, 50 into 2 be 100 rupees. See, then only my debit is equal to my credit 600. Okay, so this is how my ninth journal entry just changed a little bit when securities premium was unpaid. So only when securities premium is unpaid, it will reflect in the given journal entry. There will be a debit effect to be given. Okay. Now moving on to sixth, last one. Okay. 50 shares of Mr. X, which were forfeited, were reissued to Mr. Y for rupees 9, fully paid. Okay, so now this 50 shares I have given it to Mr. Y, directly fully paid up shares. Okay, so I am going to receive money in the account. So the 10th journal entry, bank account debit. I am going to receive 50 rupees, 50 shares into 9 rupees on one share. No? So 50 into 9, 450. But my equity share capital, directly we do the receipt entry over here. Okay, now again the stages don't come. Okay, to equity share capital, 50 shares into 10. Always at face value. So that means this is a discount, no, of 1 rupee. Discount on issue. How much discount I have given? 1 rupee. Right. But instead of writing discount, okay, discount on issue, I am going to write share forfeiture account. Why will I write share forfeiture account? Because I am having X. X had paid me some money which is lying in my share forfeiture. So let me write off that loss on that reissue with the help of share forfeiture. I am having share forfeiture in the company. Okay, I am having share forfeiture as an amount which I am not going to refund it back to Mr. X. So I have that line with me. So let me use share forfeiture account to write off the loss on issue. This is a discount, not to write off the discount on the reissue. This is a reissue journal entry. Okay, reissue. Alright. So this reissue I am going to write it to share forfeiture account. And then whenever those shares, whatever shares were there of Mr. X are now given to Mr. Y. Okay, the entire story of this 50 shares is now over. I have to close my books for this 50 shares. So I have to close my share forfeiture account also. So I will have to transfer balance of share forfeiture account. SF means share forfeiture account to capital reserve account. Capital reserve account. This will be your last journal entry. Whatever is the balance remaining in the share forfeiture, you have to transfer it to the capital reserve. So as per this example, if I'm taking this particular 9th journal entry, okay, you all can take it as per this one, 9th journal entry. If you're taking that, then in my share forfeiture 250 rupees were there and I used only 50. So 200 you will transfer. But I am using this particular last one, this 9th one. In my share forfeiture account there was 100 rupees. And I have now used 50 rupees at the time of issue. So I am left with a balance of 50 rupees. So I will transfer that. So the journal entry will be share forfeiture account debit. Share forfeiture account debit 50 to capital reserve account 50 rupees. Okay, so the story of this 50 shares of Mr. X reissued to Y, everything is sorted. Now this particular shares are not there with the company anymore. It is given to Mr. Y. So I will have to close the share forfeiture account also. Okay, so done. Clear. I am going really very slow. I am trying to help you all with the entire concepts. I don't want you all to get stuck anywhere. So if in a given MCQ you are not able to solve it directly, try to pass some quick journal entries based on this. You will get the answers fast. Okay. So I hope until here it is clear. Right. We will solve 1 2 sums, then we will get a better idea. Let's move to this particular question. Okay. Very easy one, basic one. P Limited was registered with an authorized nominal capital. Authorized share capital is the one with which company gets registered. Okay, incorporation happens. Not necessary company has to issue that entire capital to public. They can keep issuing little, okay. They have 1 lakh equity shares of rupees 10 each. Now out of this 1 lakh shares, which is an authorized capital, only 50,000 equity shares were offered to public for subscription. The shares were payable as under: on application 3, allotment 2 rupees, on first call 2 rupees, and on final call, second and final call 3 rupees. The shares were fully subscribed and money was duly received. Show the journal entries, show the journal and the book entries. Okay, so simple. Immediately I will start with my application stage. The first one, receipt entry. Okay, bank account debit to share application. It is just a quick revision. I want to solve this sum fast. 50,000 into 3 rupees. Okay, So you have to just do it over here, 1,50,000. And there is nothing, there is no calls in arrears, there is no share forfeiture, there is no securities premium, nothing is there. And then second, you will do share application to equity share capital. This will be your transfer entry. Okay. So I'm giving you all 5 minutes time. Please just solve it. Then go to your allotment stage. First it will be transfer. So it will be share allotment account debit 50,000. Okay. Application is 2 rupees. No, application was 3 rupees. No. So your allotment is 2 rupees. So 1 lakh. 2 equity share capital account 1 lakh. After the transfer, receipt will take place. Okay. So bank account debit. So if I am asking you in the MCQ, how much will be the bank account debited at the allotment stage? So now you all will start looking, oh my god, what is this question? How much is the bank account going to get debited at the allotment stage? Simple. Number of shares issued to public into amount received on allotment to share allotment account. Okay, similarly you have to do it for the first call and for the final call. Okay, transfer receipt, transfer receipt. There is nothing which is something new in this sum at all. Okay, if you all have seen my example properly, you all can solve this particular sum by yourself. Okay, so first call and final call you all can solve it. Okay, I am moving to another question. Enjoy Limited allotted 10,000 shares to applicants for 14,000 shares. Okay, I think, wait, I will just give you all 2 minutes. You all finish this because it is just 4 journal entries. First call and final call. Complete it. Okay. Done. I'm moving to question number 2. Enjoy Limited allotted 10,000 shares to the applicants for 14,000 shares. Okay. On pro rata basis. The amounts payable was rupees 2 on application, 5 on allotment including the premium of 2 rupees, 3 was on the first call and 2 was on the final call. Mr. Vikas, who was holding 300 shares, he failed to pay the first call and the final call on his shares. All the shares were forfeited and out of that 200 shares were reissued at rupees 9 per share. Give the accounting treatment. Also state the amount which we have to transfer it to capital reserve. Okay. Now first thing I want you all to understand, there was applications received on 14,000 shares. But the company can allot only 10,000 shares. They have not refunded. They are saying they have done it on pro rata basis. Okay. Allotment they did on pro rata basis. Fine. Okay. So now when I will start my journal entries, before that I am just writing here on application I am receiving 2 rupees. On allotment I am receiving 5 rupees, but that is including a premium of 2. So I am writing this 2 rupees separately. It will be 3 plus 2, 5. On first call 3 rupees and then on again final call there is 2 rupees. So total face value 10, premium is 2 rupees. Okay. I'm starting with my journal entry. My first journal entry will be receipt of my application stage. Okay. So it will be bank account debit. I'm going to receive money as per 14,000. 14,000 applications have come. Not 10,000. Company had removed an issue of 10,000, but I received applications for 14,000 shares. 14,000 shares into 2 rupees. 28,000. 2 share application. Okay. And then I'm going to transfer this share application to equity share capital account. There is no premium anything over here. My application stage is done. Okay, now coming to my allotment stage. Okay. I just want to show you all what small things. Say suppose, since this example is there, say suppose I would have not adjusted this pro rata. Okay, and I would have just refunded. Okay, so here equity share capital. Okay, equity share capital also, yes. Equity share capital I'll record it only on 10,000 because I have only that much. Okay, as a company I have only 10,000 seats, 10,000 shares which I can allot. So I'm going to write this as 10,000 into 2. 10,000 into 2. 20,000. Say if in case I would have refunded this. Okay. So here I would have to write again to bank. Sorry. I would have to write here to bank. If in case I would have refunded and not adjusted them. So how much I have refunded? 4,000 shares into 2 rupees. I will have to refund them all. Okay, so here it would come 8,000. If in case it would have been refunded. But it is not refunded, it is adjusted. It is pro rata. Adjustment means what? I am adjusting my additional money received at the time of her allotment. Okay. So since it is not refunded and it is adjusted, then instead of writing here to bank, it is adjusted at the allotment stage. No? So I am here going to write to share allotment. Since it is adjusted. Since application money is adjusted with allotment. Okay, important. Okay, many times access money which we received at the time of application, generally companies adjust that money at the allotment stage if they are doing pro rata. If it is a refund, then it is very simple. Directly from my bank account I will refund everybody, so I will credit my bank account. Okay, that just I showed you all that, right? But say now since I'm doing pro rata, I have to do the adjustment. So this is done. Now I'm going to my allotment stage. So my application stage is over. Now at the time of my allotment, my third journal entry, I will first pass the transfer. Okay, so share allotment account debit on 50,000 shares. Allotment money is total is 5 rupees because it is including the premium. So here it is 50,000. Okay, in application there was no premium, nothing at all. Okay, if they would have mentioned. So now they have mentioned it for the allotment stage. So to equity share capital. Equity share capital always at the face value. So 50,000 into 3 rupees. Okay. Not 50,000. No? 10,000. Sorry. 10,000 shares. 10,000 shares into 5, 10,000 shares into 3. So this is going to be 30,000. To securities premium account, any money received as a premium by the company on the shares is transferred to a separate account, securities premium account. Okay, so this is done. Now transfer stage is over. Now I am going to have my receipt stage. Now in the receipt stage, I have to keep in mind, I have already tried to adjust that allotment money in the application stage. So now when I receive money for my allotment in the bank account, okay, bank account debit, it will be what? On 10,000, I'm supposed to receive 5. 10,000 shares 5 rupees, that is 50,000. But I have already received additional of 8,000 at the time of application. So now I am not going to receive that. I have adjusted it. So it will become 42,000. To share allotment account. 42,000. Okay. To share allotment account 42,000. Now writing here, allotment stage is over. Application stage is also over. Okay, I had to show you all this most important thing, this excess money adjusted with share allotment. Now first call and final call, important one. Okay, now what is happening in my first call? I'm continuing over here, first call and final call. First call, I will first do the transfer entry. So my fourth journal entry is over, now my fifth one. Share first call account, debit. On 10,000 shares, it is I think 3 rupees, first call. On 10,000 shares, 3 rupees. So 30,000. To equity share capital account, 30,000. Now my receipt entry for share first call. But it is given to me that Mr. Vikas, he was holding 300 shares. He is not paid me my first call and my final call. So on 300 shares, there is calls in arrears. Okay. So in bank account debit. How much money I am going to receive? I am not going to receive money on 10,000 shares. I am going to receive money only on 9,700 shares. So it is 29,100. Why? Because there is calls in arrears on 300 shares for rupees 3. That is 900. To share first call account, 30,000. Okay. First call is done. Receipt transfer both. Okay. Now final call. Final call transfer entry. Share final call. Account debit. I'm going to receive 10,000 into 2 rupees. 20,000. On final call, this amount is 20,000. 2 rupees no, on final call. To equity share capital, 20,000. But Mr. Vikas did not pay me. So at the time of receipt, I'll come to know that he again did not pay me. So bank account debit, I'm going to get money only on 9,700 shares. Okay, into 2, 19,400. Calls in arrears on 300 shares, 600 rupees. To share final call. 20,000. Okay, clear? All the 8 journal entries until now it is over. Okay, all the 4 stages are over. Now this Mr. Vikas, he did not pay me, my first call, final call. So the shares are now forfeited. Okay, so when I will pass, now my share forfeiture entry I'll have to pass. Okay, so your entry, share forfeiture, 300 shares. So equity share capital account debit. I'm cancelling 300 shares at the face value of rupees 10. Okay, so 3,000. Securities premium is paid. It is paid. It will not get recorded. Okay. So 2 calls in arrears. Calls in arrears is always on the unpaid amount. Unpaid amount is 5 rupees. 3 plus 2, 5. Okay. So here it will be 1500 to share forfeiture account. Paid amount on the face value. Paid amount is 5 rupees. Paid amount is only 5 rupees on the face value. Do not take 7. Don't do that mistake. Okay. 1500. Okay. Paid amount on face value. I'm writing this again and again so that you all don't forget. And this is unpaid amount. Unpaid. Total. Share forfeiture understood. Journal entry done for that. Now they are saying that out of the 300, 200 shares were reissued at rupees 9. Okay, so journal entry number 10. Reissue of 200 shares at rupees 9. That means it is at a discount. Right, so I'm going to receive money at rupees 9. No? Bank account debit. 200 into 9. Okay, 1800. To equity share capital account. Here, face value is always going to remain 10. And equity share capital is always recorded at face value. There is a discount on the reissue. I will use my share forfeiture account. How much is the discount? Rupees 1. So 200 rupees I have used from my share forfeiture account. Now whatever is the balance in the share forfeiture, I will transfer it to the capital reserve. That is what I have told you. But understand one thing. Okay, number of shares which are forfeited are 300. But the reissue are not completely 300. They are only 200. That means company is still having that 100 shares with them. Okay, company forfeited 300 shares. Okay, forfeited 300 shares. But they have reissued only 200. That means company is still having that 100 shares with them. They might reissue it later on to somebody. Okay, so I cannot now, currently I cannot compare this share forfeiture account because this share forfeiture is created on 300 shares and this is created on 200 shares. This is used for 200 shares only. If it would have been for all 300 shares, I would have just taken the balance and transferred to capital reserve. But here I will have to again do pro rata. Now what is that pro rata? Okay, pro rata. See, when the shares forfeited were 300, okay, amount which was transferred to share forfeiture, the amount created in the share forfeiture was 1500. Let's see here. When shares were forfeited 300. Say suppose I would have not forfeited 300 and I would have just forfeited 200. Then how much amount would I have generated? Cross multiply. It will come to 1000. So for 200 forfeited shares, amount generated in share forfeiture would have been 1000. From that 1000, I will subtract 200. So minus 200 balance is 800. This 800 will go in share forfeiture to the capital reserve account in journal entry number 11. Share forfeiture account, debit 800 to capital reserve 800. Okay. Once again, since the number of shares forfeited are more than the shares reissued, I cannot take the balance here. 1500 minus 200, 1300 transfer to share capital reserve. I cannot do that. Okay. I will have to use pro rata amount. So if I would have forfeited only those shares which I want to reissue, what would have been my share forfeiture? So out of that, 800, 1000 is the amount. I have used 200. So 800 only will get transferred to capital reserve. I hope everyone has understood this sum. It spoke about oversubscription, excess money on application adjusted at the allotment, difference of the forfeited shares and reissued. All this is also covered in the sum. Okay, so I have taken this sum to make your concepts more strong before we go to the past exam questions. Okay, so now all my past exam questions are ready. Okay, I am giving you all one 5 minutes break. Okay, 5 minutes break. Okay, we resume at 11. Sorry, we resume at 12:35. Okay, just take a 5 minutes break. Go through whatever you all have written, all the concepts. Okay, and then we start with the exam questions. Okay. Okay. Now let's start with the past exam questions. Alright. We have to solve them all. Shiva Limited forfeited 4,500 equity shares of rupees 10 each. They were issued on 40% pro rata basis on non-payment of allotment at rupees 6. This is including a premium of 2.5 and the first call and final call of rupees 3 per share. First and final call is collected together. If the excess money which was received on application is used for receiving the amount due on securities premium, what amount should be credited in the share forfeiture account? Don't worry, it is a very easy one. How to solve, if you all will know one no, you all will be able to solve almost all. Okay, same thing. Okay, past exam questions. Come on. You all can hear me? Yes, you all can hear me. I hope. Okay, the first one. Now since I'm just writing you all the given over here. They are saying Shiva Limited has forfeited 4,500 shares. So we have to do calculation on 4,500 forfeited shares. Okay, forfeited shares. Face value is rupees 10. Face value is rupees 10. And how is that face value collected? The amount collected on the share is on application stage. There is one allotment stage. And there is first and final call together. First and final. Okay, now they have given me that on the allotment stage, it is rupees 6, including the premium of 2.5. So if it is including a premium of 2.5, that means on face value at the time of allotment it is 3.5. Okay. Only then that will become 6. And on final call, they are saying first and final call is rupees 3. Face value is 10. So on 10, from 10, 3 and 3.5. If I will subtract, I will get again 3.5, which that means on application 3.5 rupees was collected. Right, on application 3.5 rupees was collected because all this is given. Okay, now they are saying that the allotment was done on 40% of pro rata and there is non-payment of allotment money. So he paid application money, 4,500 pay. Application money is paid. From here all this is unpaid. So there is an excess money received at the time of application because allotment has happened only on 40%. Okay, so what does this mean? Allotment has happened on 40%. That means this 4,500 shares are only 40%. So 100% would have been how much? So you have to just do 4,500 into 100 upon 40. Or easy directly you can do 4,500 divided by 40% or 4,500 divided by 40%. You will get 11,250. That means shares applied are 11,250. Okay, 11,250 into 40%. If you will do, you will get 4,500. Applied shares are 11,250 but allotted are only 4,500 shares. So now since I got the number of shares applied, Therefore, application money received will be equal to 11,250 into 3.5 into 3.5. Just multiply and see. You will get 39,375 rupees on application. They are telling me if the excess money which is received, it is adjusted to the unpaid securities premium, then what will be the amount to be transferred to the share forfeiture account. Okay, now unpaid securities premium is equal to, on 4,500 shares, security premium is 2.5. That means 11,250 is the unpaid amount of securities premium. They want to adjust this. So amount transferred to share forfeiture account will be equal to total of the receipts minus the security premium adjustment. Okay, they are telling me that we have adjusted the excess money of application with security premium not paid. So total receipt is how much? We just found 39,375. Total receipt on application stage is 39,375 minus security premium unpaid is 4,500 into 2.5, which is 11,250. So amount transferred to share forfeiture account is 28,125. Okay, excess money received in the application stage is 39,375. They are saying whatever is received excess, that we are using and we are kind of writing off. We are using it for the unpaid securities premium. Securities premium unpaid is on the allotment stage. Allotment is only of 4,500 shares. So 4,500 into 2.5, and the answer is 28,125. Okay, I am moving to the next question. P Limited forfeited 5,000 equity shares of rupees 10 each for non-payment of first and final call of rupees 2.5 per share, which were reissued at a premium of rupees 3 per share receivable at allotment. Out of this 5,000 shares, 3,200 shares are reissued at rupees 8 per share as fully paid up. The amount transferred to capital reserve is equal to how much? Okay, so basically, okay, question number 2. 5,000 shares are forfeited. Okay, but reissued are only 3,200. Okay, so amount, I am just doing the workings with the base of the amount on the reissued shares. Okay, so share forfeiture always amount paid, no? Amount paid or amount received on 3,200 shares will be equal to 3,200 into, it is non-payment of first and final call. 2.5 is only unpaid. So 10 rupees share, 2.5 is only unpaid. So paid will be what? 10 minus 2.5 now. Face value amount of the share is 10 rupees. Okay, unpaid amount is of 2.5. Okay, so here it will become 24,000. This 24,000 you will transfer to the share forfeiture account. I am just taking the face value. Okay, This were reissued at a they were issued at a premium. So that means there must be application stage, there must be allotment stage, and first and final call. This is only unpaid out of 10 rupees. Premium is separate. Okay, so in share forfeiture, this must have been paid, no? 10 minus 2.5. 7.5 is paid, no? So I am just taking that much. I have taught you all. Share forfeiture always the paid amount on the face value. 24,000 is there in share forfeiture. Okay, as per 3,200 shares. Now loss on reissue. Loss on reissue. 3,200 shares are reissued as rupees 8 per share. So the loss is 10 minus 8. 3,200 into 2. 6,400. This loss I can use it from share forfeiture. Therefore, amount transferred to capital reserve will be 24,000 minus 6,400, 17,600. I could have done 5,000 shares forfeited, amount for 5,000 shares in the share forfeiture, then pro rata. But I'm trying to save your time. I did the working of share forfeiture with the help of the number of shares to be reissued, 3,200. Because they are asking me amount to be transferred to capital reserve. So instead of working for the share forfeiture 5,000 and then removing the pro rata and then transferring to capital reserve, instead of that, I did the working of share forfeiture with the help of 3,200 shares. Okay, because you do not have so much of time in the exams. So I am showing you all this all from the MCQ point of view. Sorry. Now let's go to question number 3. Okay. C Limited invited applications for the issue of 20 lakh equity shares of rupees 10 each, payable 3 on application, 20 lakh shares, okay, 3 on application and 7 on allotment. Applications were received for 35 lakh equity shares. Applications out of for that 7 lakh shares were rejected and pro rata allotment was done to the remaining applicants. Excess application money was adjusted for the sums which were due on allotment. Ravi could not pay the allotment money on 2,500 shares allotted. Okay. The amount received at the time of allotment will be how much? Okay. Now carefully understand this sum. Okay. Carefully. Okay. It is easy, but it has got more of working. Okay. Question number 3. I am going really at a slow pace. Okay. So that you all understand each and everything. Now see. Number of shares issued 20 lakhs. Applications received is for 35 lakh shares. Out of that 35 lakhs, they said 7 lakh shares they should reject and refund. So now I am left with 28 lakh shares that I have to adjust and do the pro rata. So my pro rata ratio will become that if you have applied for 28 shares, you will get only 20 shares. Application is to allotment. Okay. I have to do the working of 2,500 shares also. Why? Because allotment money is not paid for that 2,500 shares. So if I am saying that that Mr. is allotted 2,500 shares, who is that Mr. Ravi? Ravi is allotted 2,500 shares. That means how much he must have applied for? He must have applied for 3,500. Cross multiply. 2,500 into 28 divided by 20. He must have applied for 3,500 shares. question they are asking me, the amount received on allotment will be. Why are they asking me? Because there is also a lot of rejection happening. Application excess money on application is then adjusted with the allotment. Also 2,500 shares I have not received my allotment money. So I have to calculate the total amount received. Now how is that? First thing, I will find the excess money. Okay. I am just finding amount received on allotment, but first excess money received on application. 7 lakhs so I have refunded. So totally I am not accepting only. I am just accepting 8 lakhs more shares. Okay. So excess money received on the application will be 28 lakhs shares minus 20 lakhs. No. On more extra 8 lakh shares, I am taking application money of rupees 3. It's given to me over here. 3 rupees on application and 7 rupees is on allotment. Okay. So I am taking excess of 24 lakhs rupees. This money has to be adjusted at the time of allotment. So amount received on allotment will be, actually it will be amount due first on allotment, actual amount due on allotment minus advance received in application, excess advance received on application minus calls in arrears. Okay. So amount actually due on allotment is how much? On 20 lakh shares, amount to be paid on allotment stage is 7 rupees. Okay, so do properly. Okay, 20 lakh shares, and I will solve it. It will be 20 lakh shares. I should receive on 20 lakh shares 7 rupees. Also, I have received some excess amount in the application stage, which I have to adjust here. So I already found out that 24 lakhs minus calls in arrears. Now calls in arrears will be how much? Okay, calls in arrears. See, Mr. Ravi, okay, on allotment he should pay me 2,500 into 7. 2,500 into 7. 17,500 he should pay me. But he has not paid me. Right? That much is his calls in arrears. But no, I have received some excess amount at the time of application. Okay, he had applied for extra 1,000. He had applied for 3,500 shares. No, so that means at the time of application, I have received money 3 rupees as for 1,000 shares. Okay, that is 3,000 excess money received on application. So actual calls in arrears is only 14,500 of Mr. Ravi. Once again, I am explaining. Mr. Ravi is allotted 2,500 shares. So he has to pay me on allotment 2,500 into 7. 17,500, which he did not pay. I have to put that as calls in arrears. But when he had applied for 3,500 shares. So for this extra 1,000 shares, he had already paid me rupees 3. I should have ideally refunded it, but no. So 3,000 rupees I will subtract excess money on application. So 14,500 is actual calls in arrears. So amount received on allotment here will be 20 lakhs into 7 minus 24 lakhs minus 14,500. When you will subtract, no, 20 lakhs into 7. 1 crore 40 lakhs minus 24 lakhs minus 14,500. You will get 1 crore 15 lakhs 85,500. Here the answer is 1 crore 15 lakhs 85,500. Okay, clear? Let's go to the next question. Okay. Z Limited has issued 5,000 equity shares of rupees 10 each at 10% premium, which is payable on allotment. The company received application money at rupees 3 per share and allotment money on only 4,500 shares. That means 500 shares as calls in arrears at rupees 4 per share. The company then forfeited these 500 shares for non-payment of allotment money. What will be the, at the time of forfeiture, what will be the amount which will be, what at the time of forfeiture account, equity share capital account will be what? Will it be debited by 5,000? Will it be debited by 3,500? Debited by 3,000 or credited with 3,500? Now understand one thing over here. Okay, application money is rupees 3 and on allotment it is rupees 4. Okay, and the face value is rupees 10. That means final call is not yet done. First or final call of rupees 3 is not yet done. Called up amount is only 7 rupees. Only 7 rupees is called. First final call is not yet done only. Immediately after allotment, non-payment of allotment money, the shares are forfeited. Okay. So here, okay. Question number 4. There are 5,000 shares which were issued. Right? Face value is equal to 10 rupees. Premium at the rate of 10%, which is equal to 1 rupee. Application money is rupees 3 and allotment is rupees 4. So total called up is only 7. Called is 7 rupees. At the stage of allotment, this 1 rupee security premium is there. Okay. Allotment money was received only on 4,500 shares. That means on 500 shares, there is calls in arrears. So whenever I forfeit, I have to pass a journal entry. So I will say what? Equity share capital account debit for forfeiture. How many shares I am going to forfeit? 500 shares. Okay, for the non-payment of allotment money, I am forfeiting. I am not waiting for the first call, final call. So here I cannot multiply by 10. I'll multiply by only 7 because the called up amount is only 7. Okay, so here it will become how much? 3,500. See, I'm just passing the journal entry for you all to understand. Security premium is unpaid. So whenever it is unpaid, it will always reflect. 2 calls in arrears. Calls in arrears is on the total unpaid amount. So total unpaid amount is 500 into 5. 4 plus 1. Total unpaid amount. This will be 2,500. To share forfeiture account, if I had to pass, if I had to just pass this journal entry, it would have been 500 into paid amount. See. So equity share capital account will be debited by 3,500. This is the answer. Okay. I am moving to the next question. Question number 5. Okay, a company has subscribed capital of 2 lakh equity shares of rupees 25 each. Rupees 20 per share is only called up. 5 rupees is not yet called up. The directors forfeited 200 equity shares held by a shareholder who failed to pay the first call made at rupees 10 per share. Okay. Later, the directors reissued these shares as rupees 20 per share, paid up at rupees 15 per share. On reissue, amount to be transferred to the capital reserve account is how much? Okay. Question number 5. If you all don't understand the question, read it twice. Okay. There are 2 lakh equity shares. Okay. On 2 lakh equity shares, the amount is rupees 25 per share, but only rupees 20 is called up. Okay. Out of this 2 lakhs, 200 shares details they are telling me that they have to be forfeited. Why they have to be forfeited? For non-payment of first call. Who failed to pay the first call of first call money. First call money is rupees 10. Okay. So total called up is, say if it is 20, total amount called up, rupees 10 will be on the first call. And in this is first call. No? So application and allotment together would have been 10 rupees. This he paid, but 10 rupees he is not paying. Okay, I have to kind of forfeit, and then out of this 200, all these shares are reissued at rupees 15 per share. Okay, fine. But in the share forfeiture, how much will be the amount? Share forfeiture is always on the amount which is paid. Okay, so 200 shares, how much is the amount paid? 10 rupees. 2000 is in the share forfeiture account. Okay, loss on reissue. Loss on reissue. I'm going to reissue all the 200 shares, but at rupees 15. So my loss on reissue is 20 minus 15. My called up value of the share is 20 minus 15. So 200 into 5, that is 1000. Okay, therefore amount transferred to the capital reserve will be 2000 minus 1000, which will be equal to 1000. Okay, called up amount only I will have to see it. Company has not yet called up that another 5 rupees, 25 rupees, no, the share value. 20 is only called up. So all the working also I'll do as per called up only. Right. So share forfeiture on the paid amount. So 200 into 10, 2000, and loss on reissue. When I'm reissuing at rupees 15. My called up amount of the share was 20. If it would have fully been called up, I would have done it as per 25. But no, how much ever the company calls up, that is the value I will take. Okay. Done. Now the next sum. ABC Limited issued 1 lakh equity shares of rupees 10 each. Now this sum is a little lengthy. It has got all the sub questions, means all the other questions are also based on this question. Okay. ABC Limited issued 1 lakh equity shares of rupees 100 each. They are payable as under: on application 30 rupees, allotment 30 rupees, and on final call 40 rupees. Done. 100 rupees is total. 1,45,000 applications were received as under. Applicants for 25,000 shares, they were allotted full. Okay. And applicants who applied for 1 lakh shares, they were allotted 75,000 shares. Only then, no, 25 plus 75 will make 1 lakh. They were allotted on pro rata. Remaining all the applications which we had in extra, we rejected. Amount received at the time of application will be how much? This is the simplest question. Okay. At the time of application, number of applications received into the amount which is payable on application. 1,45,000 into 30, that will come to 43,50,000. Right? Keeping the same question, how much excess money is received at the time of application? Excess money received will be how much? See, 1,45,000 into 30 I have received. But I can allot only 1 lakh shares. I should have received 1 lakh into 30. So 43,50,000 minus 30 lakhs. That will be equal to 13,50,000. Easy. As per this question again, amount to be refunded will be how much? Okay. How much I will refund the ones which have rejected? Rejected applications, I will refund them all the application money which they have paid me. Now, how many is the rejected application? I received applications for 1,45,000. From that, 25,000 fully they were allotted, and the rest 1 lakh, may say I took only 75,000. Means rest 1 lakh. Out of the applied 1 lakh shares, allotment was done to 75,000. That means I adjusted 1 lakh shares. Okay. Into the application money is 30 rupees. So it will be 6 lakhs rupees. Right now, out of this 1,45,000, again I am explaining. Out of this 1,45,000, this is an excess amount. I to have only 1 lakh seats, 1 lakh shares. What did I do is 25,000. So say 25,000 was fully allotted. Okay, and then 1 lakh shares I did it as per pro rata and then allotted them 75,000 shares. Okay, so you can do 1,45,000 minus 25,000 minus 1 lakh. So I tried to adjust 20,000 shares. Refunded 20,000 shares. Refunded. Okay, so 20,000 shares are refunded. 20,000 into 30. In this question, amount of excess application money available for the adjustment against the allotment money will be how much? Okay. So here, excess money, excess amount adjusted on allotment is equal to amount received on pro rata. Easy, pro rata applications, amount received on pro rata applications minus amount of share capital allotted. Okay, these are the easy ways and quick ways to solve it. So amount received on pro rata applications. Pro rata I have done for how much? 1 lakh shares into 30 rupees. Minus I allotted them only 75,000 shares into 30 rupees. So amount in excess will be how much? It is going to be 25,000 into 30. So that is going to be 7,50,000. Okay. Easy. Amount in excess is adjusted. No, adjustment is done on allotment. How did I adjust it? For 1 lakh shares, I am allotting them only 75,000. So excess money, how much it is? 1 lakh into 30 minus allotment. So I have done only of 75,000. Right. So that is how this is solved. Now coming to question number 10. L&M allotted 20,000 shares to the applicants of 28,000 shares on pro rata. So my pro rata is how much? 28:20. The amount payable on application is 25. Kanika applied for 700 shares. The number of shares allotted to Kanika will be how much? See, application and allotment. The ratio is how much? 28:20. Kanika was allotted. No, Kanika had applied for 700 shares. How much she must have got allotted? So 700 into 20 divided by 28. She was allotted only 500 shares. This is the answer. Okay. Question number 11. A Limited forfeited 1000 shares of rupees 10 each fully called up, but they forfeited for the non-payment of first and final call of rupees 3 per share. Out of this 1600 of these shares were reissued at rupees 9 per share, fully paid up. Amount to be transferred to the capital reserve will be how much? Now I am not doing the working for 1000 shares, I will do it for 600 shares. So share forfeiture amount. Okay, I'm doing directly for 600 shares. How much was paid? Only unpaid is 3 rupees. So paid was how much? 600 into 7. Only 3 is unpaid out of 10. That means 7 is paid. Okay, so 600 into 7, 4200. There is a loss on reissue, a discount on reissue. How much is the discount on reissue? For 600 shares, I am giving them at rupees 9 per share. That means 1 rupee is the discount. Amount to be transferred to, so from the share forfeiture 4200, I have just used 600 rupees. So now the balance is 3600. I'll transfer that to capital reserve. Answer is 3600. Okay. I'm not doing the working of full 1000. I explained you in the previous sum also. Otherwise again I'll have to do pro rata. I'm just doing the working directly of 600. You do not have to pass journal entries here. So you can do the directly working with the 600 shares. Okay. Question number 12. ABC Limited issued 10,000 equity shares of rupees 100 each at par, payable as under. Application 30 rupees, allotment 20, first and final call 50 rupees. Okay. Applications were received for 30,000 shares. Applications for 5,000 shares were rejected and pro rata allotment was made to the applicants of 25,000 shares. Excess application money is adjusted towards the due on allotment and calls. How much amount will be received in cash on first call? Okay. Now there are only 10,000 shares. Okay. But I have received application for 30,000. That means I have received 20,000 extra. Out of that 20,000, 5,000 I have rejected and refunded, and the balance 15,000 I did a pro rata. So 15,000 is to 10,000 will become my pro rata ratio. So in case if you have applied for 15 shares, you will get only 10 shares. Okay, then I'm just writing the application money is 30 rupees, allotment is 20 rupees, and first and final call money is 50 rupees. Okay, that makes a total 100. Now amount received on application. Amount received on application is equal to, I received it on 30,000 shares. Okay, application money is 30 rupees. So 9 lakhs minus reject or refund. Refunded 5,000 shares pay 30 rupees. 1,50,000. Okay, so actual amount received is 7,50,000. From that 7,50,000, I must have received how much? Actually, must have received on application. I should have received only as per 10,000 shares, no? 10,000 into 30. That is 3 lakhs. Okay. So This I should have received on the application. Also there is amount balance, okay, to be received on the allotment, okay, minus amount to be received on allotment. Allotment will happen only of 10,000 shares. Allotment money is 20 rupees. So 2 lakhs. Okay. So 7 lakh 50 is the application actually received. Okay. Out of that I must have received on application 3 lakh. Allotment pay I have already received 2 lakh. So the amount that I will receive in the first call will be 7 lakh 50 minus 3 lakhs minus 2 lakhs. I will have to receive that because I have adjusted that at the first call. So the first and the final call, in first and final call, 10,000 shares into 50 rupees. But I will have to adjust that 2,50,000 excess. So 5 lakhs minus 2,50,000. This will be equal to 2,50,000. Okay. How did I get that? Application money actually received 9 lakhs. I again refunded from that 1,50,000. I don't want them. What should I have actually received on 10,000 shares? I should have received into 33 lakhs. Allotment pay how much I have received? 2 lakhs. 10,000 into 20. So this excess of 2,50,000 additional, no, it is additional money is lying with me. I have to adjust that in my first call. They have told me to adjust it towards the amount on calls. Okay. So amount received on my first call will therefore be the amount which should have been received minus the adjustment, the excess. 2,50,000 will be the cash received in case of first and final call. Okay. So this was it with all the past exam questions. You all must have seen how many past exam questions are there. Okay, based on issue of shares. A very, very important chapter this is. Okay, so I hope you all have made a note of each and everything, and you all have also tried to practice these sums along with me. Okay, now I am going to start with the next one, part B and part C, which is right and bonus shares and buyback of shares. But before that, we will just take one 30 minutes break and I will be back again. Okay. We will resume again in 30 minutes. Okay, by around 1:50. Okay. Hi everyone. Come on, we'll begin again the next part. Let's start. Here we have part 2. I'm going to do with bonus shares and right shares. Okay. Now bonus shares and right shares are also a part of our chapter number 3 only, accounting for share capital. Now what is right shares basically? Right shares are those shares which are given to our existing shareholders. Okay, so the company, whenever they want to come with a fresh issue, so they may tell the shareholders who are existing that you all have a right, since you all are current shareholders, to subscribe to our more shares. So the right shares are offered to the existing shareholders. Existing shareholders. Now for me, okay, if I want to participate in the right shares, I will as a shareholder try to find out the value of right based on the market price which is currently going on. I should get some benefit, right, as a shareholder. If I'm going ahead and again subscribing to the shares of the company and company is giving me that right, I should have that value. I should know the value for that right. Okay, and that we will have to calculate in order to find out whether how much is the actual value or the benefit which we are getting from the right share. So all the sums if you will see are based on calculation of value of shares. Okay, and for bonus shares are for the issue of shares are done for no receive, nothing. There is no payment taken from the shareholders. It is totally given free. Okay, there is no consideration involved. No consideration at all involved. Obviously, again, bonus shares is given to the existing shareholders. Okay, so bonus can be given as per we already know, a current act. So as per the Companies Act, bonus you can give from free reserves, you can use your security premium, and also capital redemption reserve. Okay, capital redemption reserve is that reserve which is created at the time of the buyback, okay, of the shares. Okay, that also we are going to do. Buyback is also our next part. So this is how we are going to move ahead now for the next time. Like first we will finish with this bonus and right shares. It is a very small topic, and even the buyback is also a small topic. Okay, now let's begin with understanding the sums first. Okay, say for an example, the following was the balance sheet of AC Limited on 31st of December. So I'm just taking all through the balance sheet first. We have shareholders funds 40,000 equity shares of rupees 10 each, 4 lakhs. We have money in securities premium account, in general reserve account, and in profit and loss account. In current liabilities and sundry creditors, we have 90,000. Assets, we have non-current assets. In that we have plant and machinery and building. In current assets, we have stock and cash and bank balance. The company issued 3 bonus shares for every 4 fully paid up shares. Okay. So bonus is always given in the ratio. They are saying to give 3 bonus for every 4 shares held. Security premium account has to be utilized first. Okay. This is already the instructions which they have given. They are telling us to show the journal entries. Now, whenever the bonus is issued, since there is no involvement of money coming in, so how the journal entries are passed, we will see with the help of this sum and the example. Okay. So, say in the books of AC Limited, first I need to find the ratio of the bonus. Okay, they are saying that if you are having 4 shares, 3 shares will be issued to you as a bonus. So total number of shares held. Now if you want to see the working here, so the number of shares held to the number of shares given as bonus. If you have 4 shares, I'll give you bonus of 3 shares. So now totally we have 40,000 shares as per our balance sheet. I'm keeping the balance sheet in front of us. We have 40,000 shares. Okay. So according to that, 40,000 into 3 divided by 4, we will get the number of bonus shares issued. So I am going to issue 30,000 shares. So ideally the company is going to need how much of money? 30,000 into 10. 30,000 into 10, 3 lakhs rupees. So I'm going to use that from my reserves. I'm not taking any money from my shareholders. So if I'm using that from reserves, I will pass the journal entry as securities premium account. They have told me to use securities premium account first. So I'm totally using first my 1,40,000. Then I'm using my general reserves account 70,000, and I still need more 90,000 that I'm going to use from P&L account to bonus to equity share holders rupees 3 lakhs. So simple the journal entries are. Bonus issue journal entries are only two. All the reserves which you are using to bonus, and then bonus to equity shareholders to equity share capital. Like how we were doing receipt and transfer in issue of shares. Something here is the same. Here there is no receipt, but here it is taking up from the reserves. Okay. Being bonus account transferred to equity share capital account. Moving to your question number 2. So easy. Okay. The balance sheet of A Limited as on 31st of March 2014 is as follows. There is authorized share capital of 1,50,000 rupees 10 each, but issued, subscribed and paid up capital rupees 7.5 each, called up and paid up. Out of 10, only 7.5 is called up. Reserves, we have capital redemption reserve, plant revaluation reserve, securities premium account, development rebate reserve, investment allowance reserve and general reserve, and there are sundry assets. The company wanted to issue bonus shares to its shareholders at 1 share for every 2 shares held. Necessary resolutions were passed and legal requirements were complied. You are supposed to pass the journal entries. So now, as per section 63, company can issue bonus, okay, issue fully paid up bonus to its members out of free reserves, out of securities premium account and out of CRR. But very important, revaluation reserves cannot be used. Statutory reserves are those, see, revaluation reserve we all know. Whenever we revalue an asset and if there is a profit on that, there is that put on in the revaluation reserve. You cannot use that revaluation reserve. Also, you cannot use certain statutory reserves which are for that particular purpose only. Okay, free reserves are the one which is available freely for dividend for anyone. Okay, and CRR is, if there is CRR in the balance sheet, companies will issue bonus. Okay, because that is how you can write off your CRR also. Okay, bonus issue can be made only on fully paid up shares. All these are important notes. So now existing number of shares is how much? 6 lakhs. I will divide by the called up amount 7.5. That means there are 80,000 shares. In order to find the bonus, they are giving us one bonus out of 2 held. Okay, so bonus upon held 80,000 total. 1 divided by 2, 40,000 shares I am going to get as bonus. In order to issue bonus, your shares have to be fully paid up. So first, I will make the final call of that 2.5. What is the journal entry for a final call? Equity share final call account debit 80,000 into 2.5 to equity share capital. And then we have bank account debit to equity share final call account. Okay, so once the final call is done, equity share capital becomes fully paid up. Only then we can do the bonus. Now, when here you do the bonus, we will use CRR first. We cannot use plant revaluation reserve. So we will use capital redemption reserve. Then we will come to securities premium account. We cannot use all this development, investment allowance reserve unless it is told to us. Okay. Generally, whenever there is a bonus, there is one trick of remembering which reserves to use. So CSCOD. You first use your CRR, then use your security premium, then use any kind of your capital reserve, then other non-divisible profits. Okay, only if they have told to utilize. If they have not told us to utilize, you cannot use it. Only if it is told to us to utilize that particular other non-divisible profits, then only. And then last is the divisible profits. This is generally the way, write-off of Using of the reserves is done for the purpose of bonus. But mostly it is from CRR, securities premium and free reserves. Okay, so you will not find also any some other sums like this. Okay, ever being asked. So I have used CRR first, then securities premium account. Now how much I need? I need 4 lakhs, no? 40,000 shares as bonus, rupees 10. So 1,50,000 is done from securities premium, CRR already used. Okay, so from now general reserve I'll take only balance 1 lakh. Bonus to equity shareholders to equity share capital account. Clear? Question number 2. Now moving to question number 3. Balance sheet of Z Limited issued and paid up capital 20,000 shares of rupees 10 each, profit and loss account, debentures, sundry creditors. Then we have freehold property, stock, sundry debtors, cash at bank. It was resolved at the AGM to pay dividend of 10% and corporate dividend taxes 12.5%. Surcharge of 10% and 2% is of education cess. Issue one bonus for every 4 shares held to give existing shareholder option to buy 1 share of rupees 10 for rupees 14 each for every 4 shares held prior to the bonus. That means there is bonus, there is also right issue, there is also payment of dividend. Okay, now whenever they have already specifically told me that right issue is done prior to the bonus. So first I will have to move to my right issue. Okay, in the books of Z Limited, calculation of the right shares. How many right shares are we are getting? Existing shareholder option to buy 1 share at rupees 10 for rupees 14 for every 4 shares held. So it will be 1 divided by 4 and we have 20,000 existing shares. So 5,000 shares will be my right shares. Now for the bonus shares, in my existing 20,000, I will add my right issue and then give them the bonus. So the bonus is 1 share for every 4 shares held. So into 1 divided by 4, so 6250 shares are bonus shares. Okay. Now coming to the journal entries. First I am paying the dividend. How much dividend we are paying? We are paying a dividend of 10%. 2 lakhs into 10%. Existing shareholders are getting the dividend, the first one. Okay. 2 lakhs into 10%. And corporate dividend tax you will do 14.025%. Now how did I get that? Okay, corporate dividend tax. Okay, basic rate is given 12.5%. Surcharge is 10%. 10% of 12.5. You add that, you get 13.75. Plus you will do the education cess on 13.75. 2% of education cess and then add it. Your effective rate of corporate dividend tax will be 14.025. Okay, to corporate dividend tax. Dividend account debit, corporate dividend tax account debit to bank account payment done by the company. Okay, so I am done with my first part, dividend paid. Now the second one is the first I am going to do the right issue and then go to the bonus. So in case of the right issue, I have told my shareholders I am giving them 5,000 right shares, right? At rupees 14. That means 4 rupees is premium. This has to be at 10 rupees face value. So 14 into 5,000, equity share capital will be always at face value and securities premium is 4 rupees. And then now I will do my bonus. Bonus will be what? Profit and loss account is only there with me. That's it. 1,80,000. And how many bonus shares I have to issue? 6250 into 10. I'm going to use that from my profit and loss account. Okay, bonus to equity shareholders to equity share capital. Okay, that's it with the sum. I'm moving to the next question. Now this was all relating to bonus. Very easy. For bonus we use our, first we find out the ratio of the bonus, number of shares to be given as bonus, multiply by that the face value and then use your reserves accordingly. That's it for the bonus. Now coming to the right shares. Okay, we have to find the value of right. See, A company has decided to increase its existing share capital by making the right issue to the existing shareholders in the proportion of 1 new share for every 2 shares held. You are required to calculate the value of the right if the market value of the share at the time of announcement of the right is 240. The company has decided to give this one share of rupees 100 each at a premium of rupees 120. So they are going to collect 120 rupees from the shareholders. Okay. Now, number of shares issued, number of right shares issued. If you are having 2 shares, they are giving us right 1 share. Now today I am having 2 shares and I know the market value. They have already told me the market value of my share. So 240 rupees is my market price. So my 2 shares, the value, total value of my 2 shares currently is 480. Right, the cost. If say today I want to go out in the market and buy that. So it's going to cost me 240 per share. So 480. And the right share which I am going to take from the company, I have to pay 120 rupees. Right, 100 plus 20 rupees premium. So that is going to cost me 120. So my average cost for my 3 shares, now total shares have been 3 and total amount has become 600. So my average price per share, okay, is 600 divided by 3 rupees 200. And in the market, okay, in the market the price of this share is 240. My average price of the share is 200. So the value of right is 40 rupees. Okay. So just do not compare, oh, I am getting 120 rupees and in the market it is 240. So 240 minus 120, 120 is the value of right. No. First find the average price of the share. Okay. And then that you subtract from the market price. That will be the value of your right. Coming to the next question. Fitness Limited is planning to raise funds by making right issue of equity shares to part finance its expansion. The existing equity share capital of the company is rupees 40 lakhs and the market value is rupees 45 per share. The company offered to its shareholder the right to buy 2 shares at rupees 12. Face value is 10. That means it is at a premium of 2 rupees. Each for every 5 shares held, you are required to calculate theoretical market price per share after the right issue. That means they are asking you average price per share. Okay. So let's see. Market value of 5 shares. They are giving me bonus of a right issue of 1 share for every 5 shares held. No, they are giving me right of 2 shares for every 5 shares held. So 5 shares in the market are running at 45 rupees. 225 rupees will be my cost. And if I am taking the right shares, 2 shares I'll take at 12 rupees, 24 rupees. So total price of the 7 shares total will become 249. So theoretical market price or the average price of 1 share will be 249 divided by 735.57. Value of the right will be market price minus the average price. 9.43 rupees will be the value of your right. And they are asking me last, percentage increase in the share capital. Okay, so percentage increase in the share capital will be now how much? I am going to give them 2 shares for every 5 shares held. Okay, so there is going to be an addition of 2 shares. Right? So here 2 divided by 5 into 100, 40% will be the addition in the percentage increase in the share capital. Okay, you have to use the ratio of the right issue only to find the percentage increase in the share capital. Alright, now moving to the exam questions. Okay, past exam questions. Now this past exam questions, initially when I have taken also from the time when this particular chapter was subject was a properly written subject also. Okay, probably they can ask you as a part of MCQ. Okay, and it is very easy, to solve. So why to skip such chapters? Equity shares of rupees 10 each, 8 lakh, securities premium, general reserve, profit and loss, sundry creditors. Company issued 3 bonus shares for every 4 fully paid up shares. Okay. Securities premium account has to be utilized first and then the general reserve. Issue bonus shares, profit and loss account will be debited by. Okay. So here first I will find the ratio. Okay, since there is 8 lakh rupees and 10,000 or 10 rupees is the price. So here total existing shares is going to be 80,000. Okay, they are giving us 3 bonus shares for every 4 shares held. Okay, so the number of shares to be given as bonus is going to be 60,000 shares for rupees 10 each. So I will need rupees 6 lakhs. They are saying use security premium account has to be utilized first. So from that I will be using 2,80,000. No, securities premium, yes. 2,80,000 I will use first. Okay. And then I have to use general reserve 1,40,000. So the balance to make it 6 lakhs, whatever is the balance, 6 lakhs minus 2,80,000 minus 1,40,000. I'm going to use 1,80,000 from my P&L account, profit and loss account. Okay. This type of MCQs can be asked. The company has decided to increase its share capital by making the right issue to the existing shareholders in the proportion of 1 share for every 2 old shares held. You are required to find the value of the right if the market price at the announcement is 576. The company has decided to give 1 share of rupees 100 each at a premium of 188. Okay. So, right issue is of 1 share. I am going to get my right shares at rupees 188. Okay, and already held for 2 shares, the market price is 576. So here the total 188 plus 1152. Okay, 188 plus 1152 will give me 1340 divided by 3. Okay, no, it is 576 into 2. 1152 plus 188. Sorry, premium is 188, therefore price will become 288. The price is going to become 288. Okay, so it is going to be 1440 divided by 3, it will be 480 rupees. Average price, this is average price. Now average price and market price is 576, therefore value of right will be 96. How did I get 576 minus the average price? Clear? Now the next sum. The following are the extracts of the balance sheet of OMG Limited: equity share capital, securities premium, general reserve, profit and loss account. Okay. Resolution was passed to give 3 bonus shares for every 5 shares held. So 80,000 is the current shares into 3 bonus upon 5 held. Okay. So I am going to get this as 4,800 shares. No, 48,000 shares. Okay. The face value is 10, therefore I will need 4,80,000 rupees. To issue bonus, security premium account will be debited by. Okay. Security premium account will be debited by how much? Okay, we have to use minimum, they are saying. So in order to use security premium minimum, first I will use my general reserve by 2 lakh 50, then I will use my profit and loss account also by 1 lakh 50. So 4 lakh 80 minus 2 lakh 50 minus 1 lakh 50. Okay, so I am going to use 80,000 from the security premium account. Okay, now the last sum for this particular section. F Limited is planning to raise funds by making right issue of equity shares to part finance its expansion. Equity share capital of the company is rupees 120 lakh and the market value is 155 per share. The company offered to its shareholders the right to buy two shares at rupees 36 each for every 5 shares held. Okay, so right issue is 2 shares and held is 5 shares. 2 shares I am going to get in 36 rupees each and 5 shares the market price is 135. Okay. So this is going to become 675 and this is going to be 72. This will be 747 divided by 7, no, total number of shares. So average price is going to be 106. 747 divided by 7. 106.71. This is the average price. Therefore, value of right, market price is 135 minus 106.71. 28.29 is the answer. Okay. So I hope the right issue and the bonus issue have become clear. You'll be able to solve these MCQs very easily. Okay, there is nothing to worry about. Okay. Now, okay. Now let's understand about buyback of shares. Okay, when companies at the times when they do not really need the amount of capital which they are standing with, or some of their projects are not going to happen in the near future also, they have the estimation about that. Sometimes they buy back the shares because equity shares are something which is there for the long lifetime of the company. Okay, so here the redemption is not there, like debentures are redeemed, like preference shares are redeemed. No, equity shares are bought back by the company. Okay, and they are extinguished there. Okay, they are cancelled. So buyback of the shares is when the company is again going to take the shares from the public, and to that extent the equity share capital will now reduce. Okay, the share capital of the company, equity share capital of the company will reduce. But in order to do a buyback, there are certain conditions which are given as per section 68, 69, 70 to be followed of Company Act 2013. So even our sums which are there of buyback are based on those provisions. There is also calculation, but yes, this particular chapter, do it from the Company Act point of view also. Okay, do read the provisions. There is more of theory which is asked in this chapter, quite a lot of theory. But there are certain few problems which I want to share with you all and complete that so that you don't get stuck even if a practical question is being asked. Okay. So we will start with an example only and I will take you all to the buyback entries. There are only 4 journal entries in case of buyback. Okay. Let's begin. From the following, this is the following balance sheet of ABC Limited. We have equity shares of rupees 10 each, 50 lakhs. General Reserve, PNL, securities premium, secured loans, debentures, we have secured loans. Current liabilities, we have creditors and bills payable. In assets, we have In non-current assets, fixed assets and investments. In current assets, we have cash and bank balance, stocks and debtors. Okay. The company decided to buy back 1 lakh equity shares of rupees 10 each at 25% premium. Okay. So the buyback price they have given to us. Okay. That they are going to buy back at 10 rupees each at 25 rupees percent premium. For this purpose, the company have sold their investments at rupees 6 lakhs and they have made another fresh issue of 10% preference shares of rupees 100 each to the extent minimum after utilizing the securities premium account and half of the general reserve. Now, understand one thing, whenever the buyback is there, see there are two options. Either you use your reserves. Okay. Generally, we use our free reserves. For buyback, we can also use the securities premium account. Okay. Or make a fresh issue of other class of shares. Fresh issue of some other class of shares. Not necessarily, no company will be having so much of reserves. So they will either, do a fresh issue also. Then sometimes investments are sold. Why investments are sold? So that they will have that much of cash. Also, they will make some profit in selling the investments. So investments are sold, and sometimes they use a combination of both, using from the reserves also and some amount to do as a fresh issue. So in our first question, they are telling us that you are supposed to do a fresh issue of preference shares, but to the extent minimum after utilizing securities premium account and half of the general reserve. So first utilize that, and then if it is required, you do a fresh issue of preference shares. So now how we solve this? Okay, you are supposed to pass the journal entries and also calculate the post buyback debt equity ratio. Now this they ask in MCQs. Okay, so let's see. Journal entries, I'll come to it later. Okay, journal entries is very easy. Let us understand this first. Calculation, working mode. Calculation for the number of preference shares which I have to issue. They have not given me how many, no. So first, amount I require for buyback. I have to buy back 1 lakh equity shares at rupees 10 lakh rupees plus I have to give them 25% more premium. So 2 lakh 50 rupees I'll need as a premium. They are telling me use half of the general reserve and securities premium account completely. So securities premium account is there in my balance sheet. Yes, 1 lakh rupees is there in my balance sheet. But I have to pay premium on buyback. See this. This is my premium on buyback. So for securities premium account, from fresh issue and from the balance sheet, 1 lakh rupees is there in my balance sheet. Fresh issue is at par. Fresh issue, there is no premium, nothing involved. But number of shares to be issued, they have not given me. So 1 lakh I have in my balance sheet and I have to write back the premium. Okay, I need no 2 lakh 50,000 premium I have to give. It's 2 lakh 50. So 1 lakh 50,000. Okay, which is not there in my securities premium account. I will have to take it from my P&L account now. Okay. In my P&L account, in the balance sheet, there is already 1 lakh rupees. Also, I sold the investment at 6 lakhs. Investment was costing 5 lakhs. I sold at 6 lakhs. So now I have total 2 lakhs. From there, I am using this 1 lakh 50,000 which I could not remove from the securities premium account. So now P&L in the balance sheet remaining will be only 50,000. Okay. So they are saying first you utilize the securities premium account. I have already utilized. And they are saying utilize half of the general reserve. So general reserve is 15 lakhs. Half of it is 7 lakh 50. I also have a balance now in P&L 50,000. Use the reserves and minimum possible fresh issue I have to do. Minimum possible. Okay. So I am using my P&L also, the balance 50,000. So 8 lakhs rupees I'm going to use it as a reserve. Compare this with the nominal value to be bought back. Always compare nominal value and this. DP transfer, divisible profit transferred to CRR. I will have to transfer this divisible profit to CRR. Now someone will ask me that why, ma'am? Now see, suppose this is a balance sheet. What are we exactly doing? This is equity share capital 10 rupees. When I must have issued, I in the bank I have got 10 rupees. Right? Now I am going to pay them back. I am paying them back 5 rupees. So equity share capital is going to decline by 5 rupees. Bank mein se bhi money will go 5 rupees, it will come down. Right? I am telling I am using reserves. So say general reserve also will go down. So then how will my balance sheet tally? My balance sheet will not tally. So therefore I make one account which is, there is actually no money in that. Okay, this is just for the purpose of showing that there was a redemption done of the capital by using the reserves. So to the extent of reserves which I have used, I will create another account which is known as a capital redemption reserve account. Okay, actually there is no money in this CRR. It is just used or created for the purpose of accounting treatment and to tally the balance sheet. Only if you are doing your buyback with the help of the reserves. Okay, so the nominal value you will compare of the buyback with the amount you are using from reserves. So 10 lakhs was the nominal value. Okay, and 8 lakhs I am going to use from the reserves. Subtract that, that will be the fresh issue. Fresh issue will be of 2 lakhs. Okay, now fresh issue, what they have given us? 10% preference shares of rupees 100 each. So how many preference shares I will have to issue? 2 lakhs divided by 100. 2000 preference shares have to be issued. Okay, if I am using, again I am repeating, if I am using my reserve in order to do a buyback, the amount which I use from the reserves, the nominal value, okay, the amount which I use from the reserves, that has to be from your DP, divisible profits, okay, that has to be transferred to CRR, capital redemption reserve. Now the journal entries are very easy. Okay, first I am going to sell my investment so that I have money in my bank. So bank account debit 6 lakhs, investment was 5 lakhs, I made a profit of 1 lakh. Okay, then I will do a fresh issue, so again I will have money. Bank account debit to 10% preference share capital, 2000 shares of rupees 100, 2 lakhs. Then I am going to do a buyback journal entry. For buyback, my equity share capital is going to get cancelled to the extent of 1 lakh shares, face value being 10. Okay. Then this is premium on buyback. Premium paid on buyback. How much premium I am paying on buyback? 1 lakh into 2.5. 25%, no, of 10 rupees. 2.5 I am paying as a premium on buyback. From where did I remove the premium? I took some premium. I am writing off with securities premium account, and some premium on buyback I am writing off with the help of my P&L account. It is known as writing of the premium on buyback. Okay. In the accounting terminologies, it is known as writing of the premium on buyback. From where you are going to give the premium? To equity shareholders account. Then I am going to pay them equity shareholders to bank. Totally how much I am going to pay them? 12,50,000. Equity share capital always at face value. Right? And the amount of reserves I have used and transferred to CRR, that will be the last journal entry. General reserve account I use half, and I use my P&L whatever was balance 50,000, and then to capital redemption reserve. Okay, in certain sums they will give you directly how much is the fresh issue, how much you are supposed to use the reserve, they will give you. Okay, but in certain sums they will not tell you. They will tell you use the minimum reserves, or they will tell you use maximum of reserves and minimum of the fresh issue. Okay, so this can be one particular condition. And lastly, they are asking me post buyback debt equity ratio. What is the formula for that? Secured plus unsecured debt upon paid up capital after the buyback plus free reserves. So my secured plus unsecured debt, I'll take this. Secured debt is 10% of debentures. Unsecured is creditors and bills payable. Okay, so 4 lakhs plus 10 lakhs. Creditors and bills payable total is 10 lakhs. Divide by post buyback paid up share capital. Okay, so post buyback my paid up share capital is how much? I had 50,000 share. No, I had 5 lakhs rupees of shares. 5 lakh shares, out of which 1 lakh is done as a buyback. But then there is also a fresh issue now of 2 lakh shares, preference shares. So totally 42 lakhs. Okay, and in the reserves now I am left with the half of the general reserve, 7,50,000. Okay, so 42 lakhs plus 7,50,000, 0.8. Okay, since the post debt equity ratio is less than 2, provisions of section 68 of the Company Act has been complied with. Now what are this debt equity ratio? Now these are the conditions of buyback as per section 68. Okay, debt to the equity. Fine. Now I'm taking you all to the sections and the the compliance provisions. Come, I'm going to take you all to it. We'll come to that particular example. Let us practice one more sum. Following is the balance sheet of Light Company Limited as on 31st of March 2018. Shareholders funds equity shares of 10 rupees each, rupees 10 lakhs, securities premium 2 lakh 40, reserve 7 lakh 50, profit and loss account 2 lakh 80. We have 11% debentures and creditors, and then we have some current assets. We have non-trading investments of 4 lakh 20. Okay, the company bought back 15,000 shares of rupees 48. The transaction in respect of this buyback is financed by selling 2/3 of investments for rupees 5,90,000. Show the important journal entries to record the buyback. Okay. First, amount required for buyback. I am buying back 15,000 shares of rupees 10 each. 1,50,000. But the buyback price is 40. That means the premium is 30 rupees. So 4,50,000 I am supposed to give them a premium. Fresh issue I am not doing. I am going to use only TP transferred from CRR. Okay, but first let me adjust my securities premium with the premium on buyback. Securities premium in the balance sheet is 2,40,000, but on buyback I need 4.5, means 4,50,000. So 2,10,000 I will have to take from P&L. Okay, now in my P&L, in the balance sheet, P&L is given 2,80,000, and when I sold my investment, my profit is 3,10,000. Now how? See, my non-trade investments is 4,20,000. I am selling 2/3 of it only. So 4,20,000 into 2 divided by 3. I have just sold 2,80,000 of the investment at cost, which I have sold at 5,90,000. Therefore, profit is 3,10,000. Okay, profit comes as 3,10,000. See this. So now in my P&L, I have 2,80,000 plus 3,10,000. That will become 5,90,000. Premium on buyback. Some amount I could use from the security premium. Some amount I'll have to use from P&L. So now in the P&L, I'll be left with 3,80,000 only. Okay. How much do I need from? Yes. Now in P&L account, okay, fine. I'm there with 3,80,000 as the balance. Now the nominal value. So the security premium is done separately. Nominal value 1,50,000. I'm using it from a reserve. Which reserve I'm using? I'm using general reserve. General reserves, there is 7,50,000. From that, I am going to use 1,50,000 nominal amount. DP transferred to CRR. From general reserve, I will transfer 1,50,000 nominal value of buyback. I will transfer it to CRR. So now in general reserve, my balance will be 6 lakhs. Securities premium, I have adjusted with premium on buyback. Okay, also I have used some amount from P&L for premium on buyback. And I am left with 3,80,000 balance in the balance sheet of P&L. And for general and reserve, balance will be 6 lakhs in the P&L. Now with the fresh balance sheet when I'll make. Okay, so journal entries, selling of investment, bank account debit, money received, investment 2,80,000, profit and loss account 3,10,000. I am buying back 1,50,000. Okay, 15,000 shares at rupees 10 each. And the premium on the buyback is 15,000 shares into 30. This is the premium on buyback. I am using securities premium account and P&L for premium on buyback to equity shareholders. Okay, giving them total 6 lakhs rupees. 15,000 into 40. Equity shareholders to bank, and which reserves I have used? General reserve to capital redemption reserve account. This is the most important journal entry. Okay. Yes. Now comes the question wherein we have to solve the given conditions of buyback. Problem number 3. NSZ Limited, a non-listed company, has the following capital structure as on 31st of March 2019. Equity share capital of rupees 10 each, fully paid up 313 crores rupees. General reserves, securities premium account and profit and loss account, and infrastructure development reserve, loan funds is 1,800. The shareholders of NSZ Limited, on the recommendation of their board of directors, have approved the proposal to buy back maximum permissible number of equity shares permissible under the law, considering the large surpluses which are available at the disposal of the company. The prevailing market value of the company share is 25 per share. In order to induce the existing shareholders, the buyback is offered at a price which is greater than 20% than the market. So 25 rupees is the current market price. I am giving more 20%. I am giving 30 rupees. You are also informed that infrastructure development reserve is created for IT Act, statutory reserve, that is. You cannot use that for buyback. You are required to compute the maximum number of shares that can be bought back in the light of the above information. Also, in those situations where the loan funds are 1,800, second situation loan funds become 1,200, and the third is loan funds are 1,500 crores. Okay, now this sum is a little lengthy, but we'll have to understand it. Okay, in the first situation, my loan funds are 1,800 crores. Okay, I'm solving the sum with that first situation. We have to find 3 conditions of the buyback, and the least of that we have to select. First condition: the buyback of equity shares in a given financial year should not exceed 25% of its total paid up capital in that financial year. So 25% of the total paid up capital. Total paid up capital is, total paid up capital is 330 into 25%, that will give you rupees 82.5 crore. That was the first condition. 25% of the total paid up capital of that financial year. Next condition: 25% of the aggregate total of its paid up capital and free reserves of the company. So the paid up capital is 330 plus free reserves will be general reserve, securities premium, profit and loss account. Okay. So 330 crores plus 240 plus 90 plus 910. Okay, buyback can be done from the securities premium also. So 9090. Development infrastructure development rebate is for IT Act. It is a statutory reserve. We cannot use it. Into 25%, it will come as 187.5 crore. Then the last condition, the ratio of the aggregate. Just now we solved in the first sum. The ratio of its debt to equity. Aggregate of secured and unsecured owed by the company after the buyback, okay, is not more than twice. It should not be more than twice. Then it's paid up capital and free reserves. Okay, so this I'll have to find out now. Now see this. In the question it is stated that the company has surplus funds to dispose of. Therefore, it is presumed that buyback is out of the free reserves. There is no fresh issue. Or it can be out of the security premium, and hence a sum equal to the nominal value of the share bought back shall be transferred to the CRR account. That we all know. Now buyback price 25 into 120%. Means 25 plus 120% you can do. 25 plus 20% will give you rupees 30 only. Okay. Out of which 10 is the nominal value and 20 rupees is going to be the premium. Now let the nominal value of the amount of shares that we are going to buy back is going to be X. That much amount I will have to transfer it to CRR also, because if the buyback is happening from the divisible profits. Since the nominal value is X, premium on buyback will be 2X. Now condition number 3, secured plus unsecured debt upon paid up capital plus free reserve. Okay, it should be less than or equal to 2. Should not exceed 2. That means it should be less than or equal to 2. Okay. Now let the amount of buyback be X. Amount. Secured plus unsecured debt in the first condition is 1800. Paid up capital after the buyback will be, since I have taken the nominal value of buyback as X. So 330 crores minus X plus free reserves is 240 plus 90 plus 90. From this reserves I will give the nominal value also, I will give the premium also, which will be equal to 2. So when I will solve this ratio, my X will come as minus 37.5. So since the value is minus, hence amount of nominal value of the shares that can be bought back is nil or 0. You cannot do the buyback. Since from all the three conditions minimum amount is 0, hence the buyback cannot happen when the company's loan funds are 1800 crores. Okay. So here in the last condition I have just put let the amount nominal value for the amount of buyback be rupees X. Since that is X, premium will be 2X. Based on that I have found the value of X. Now out of all the three conditions this is the least. That means I will consider it as 0. This is running in minus. Okay, therefore buyback cannot happen if the loan funds are 1800 crores. Let's go to the second situation. Second situation, everything will remain the same. Only this third situation here, instead of 1800, it will become 1200. So you will solve it as 1200 upon 750 minus 4x is equal to 2. Here in this case, you will get the value of x as x will be rupees 37.5 crores. 37.5 crores. So least. It is the least of all the three conditions. In the first condition, it was 82.5. Second condition, 187.5. So, last condition, 37.5 CR. This is the least. So, the amount of buyback is amount in rupees. Amount of buyback is rupees 37.5 CR. So, number of shares that can be bought back is 37.5 upon 10 face value. Okay, 3.75 crore shares can be bought back. And when you will put the third situation, your X will come as 0. Again, no buyback can take place because the third condition is, when you finding out with that, it is coming as 0. Okay. Now coming to question number 4. S Limited decided to buy back 2000 equity shares of rupees 100 each at a premium of 10%. For the purpose of redemption, the company issued, redemption means to buy back. Company issued 15,000 10% preference shares of rupees 10 each at a premium of rupees 20 per share. Company has sufficient balance in P&L account. Okay. At the time of buyback of the shares, the amount to be transferred to the CRR will be how much? All the MCQs are based on this only. Amount transferred to CRR. Okay. Now equity share capital to be bought back 2000 shares of rupees 100 each. Amount to be bought back. From the fresh issue, I am going to do a fresh issue of 15,000 at 12 rupees. 10%, 20% premium. That means 12 rupees. Okay. So out of the PNL, means 2 lakhs is there, minus 1,80,000. So I am left with 20,000 as an amount. So amount transferred to CRR will be 20,000. Why did I do this? Why did I take this in the premium also here in the consideration? Because buyback. For buyback, we can use securities premium. Okay. So what did I do here actually is that amount required for buyback. Same thing I've done. Okay. 20,000 into 100, which is 2 lakhs. And from the fresh issue, 15,000 into 10, that is 1,50,000. Okay. And also securities premium account. I will get 15,000 into 2. That is 30,000. So I am using both. I am using 1,50,000 also, and I am using 30,000 also securities premium account for the purpose of buyback. Okay, so from 2 lakhs I subtracted 1,80,000. Only now the remaining 20,000 I will use it from my P&L. So since I am using a divisible profit, DP transferred to CRR, DP transferred to CRR will be equal to 20,000. Okay. Now the next sum. During the year 2018-19, T Limited did buyback of 20,000 equity shares of rupees 100 each at a premium of 5%. During the year 2018-19, the company did not have sufficient balance to buy back the equity shares. Therefore, it issued 1 lakh preference shares of rupees 10 each at a premium of 15%. The company has sufficient balance in general reserve account. Find the amount transferred to CRR. Very easy. Amount required for buyback 20,000 equity shares of rupees 100 each, 20 lakhs. Premium on buyback is 5%. So 1 lakh. Fresh issue they have already told me 1 lakh shares of 10 rupees each. So 10 lakhs plus premium I am going to get 15%, 1,50,000. Okay, now first I will adjust my premium. Securities premium in my which I have received from the fresh issue is 1,50,000 and premium on buyback is 1 lakh. So 50,000 is still balance, right? In my securities premium on buyback is 1 lakh and I received 1,50,000. So I can still use my securities premium account over here. How did I use it? Out of 20 lakhs, okay, 10 lakhs is the fresh issue. This is the buyback amount. This is the fresh issue amount. So 10 lakhs I will have to use DP transfer to CRR. But from there again securities premium balance is there, 50,000. So remove that. 9,50,000 is the DP I am using. PNL I am using. So this will be the amount transferred to CRR. All these sums are very, very important. Understand, for buyback we always use security premium. If it is there, first try to adjust security premium with premium on buyback. If there is a balance left in that, then you can use it for this particular DP transfer to CRR. Reduce it to the extent of security premium you have. When you will reduce it, the balance you will transfer it to CRR. Okay, PNL transfer to CRR. DP, always DP transfer, divisible profit. Security premium is not a divisible profit. So do not transfer directly 10 lakhs. use this security premium, like how I've used it even in this sum. Okay. Now the next question. From the following are the extracts of the balance sheet of Cube Limited. Equity shares of rupees 10 each, 20 lakh security premium, reserves, P&L, bank and non-trading investment. Company bought back 30,000 shares at rupees 40 each, and buyback was financed by two-thirds of the non-traded investments for rupees 11,80,000. Calculate the bank balance after the buyback. Simple. Opening balance of cash and bank balance is 18,20,000. I have received some amount by selling my investments. How much did I receive? 11,80,000 I received. 18,20,000 was there. I sold my investment. They are asking about the bank balance, not profit. Okay. So sale of investment, when I sold, I received how much? 11,80,000. How much I have to pay back my equity shareholders? On 30,000 shares, I have to pay them 40 per share. Okay. On 30,000 shares, I have to pay them 40 rupees per share. So 12 lakhs. So closing balance in my bank balance will be 18 lakhs rupees. Okay. Now coming to last question, question number 7. Then we'll go to the exam questions. From the following information available from the audited balance sheet of PH Limited, there is equity share capital 3,000 lakh shares, security premium, general reserve, secured unsecured loan. Calculate the maximum limit up to which buyback is permitted in this given financial year. Okay, so condition of the buyback, least of all three. First will be 25% of the total paid up equity share capital of that company. So paid up equity share capital is how much? 30,000 into 25%, rupees 7,500. Then 25% of the aggregate of the total paid up capital and free reserves. So total paid up capital 30 plus free reserves is security premium, general reserve 3,000 plus 10,000 into 25%. This will come as 10,750. And the ratio of secured unsecured debt to the paid up share capital and free reserve should not be greater than 2. Okay. So let the amount, now same thing, let the amount of the buyback be X. Secured plus unsecured debt total is 62,000. Okay. Amount paid up capital after buyback will be 30,000 minus X. Plus I will also remove it from my reserves. So 3,000 plus 10,000 minus X, that will be equal to 2. So when I will calculate, X will come as 6,000. Since the least of the amount is 6,000, therefore amount available for buyback is going to be rupees 6,000 lakhs. It's in lakhs, no? And number of shares that can be bought back will be 6,000 divided by the price of the share, rupees 10 each. Okay, price of the share. So 600 shares can be bought back. Okay. Now going to my past exam questions. Very easy, the past exam questions are. They give you everything in detail. So you don't have to worry. Okay. Paid up equity share capital of Novel Limited is rupees 50 lakhs. Face value is 10 each, fully paid up. There are other details. General reserve 15, capital redemption reserve 4 lakhs, profit and loss account 1 lakh, statutory reserve and securities premium account. The board of directors passed the resolution to buy back maximum number of shares as allowed by law. The maximum number of shares that can be allowed for buyback will be how much? Now they have not given me any other information. How much is the buyback price or any other, in order to find the debt equity rate. Nothing they have given to me. So here it will be simple. Here the maximum number of shares that can be bought back will be, how many shares are there? 5 lakh shares. Correct? 5 lakh shares. No, rupees 50 lakhs divided by 10. 5 lakh shares into 25%. That will be 1,25,000 shares. Simple. Easy. That's it. Nothing is given in the sum as any other information. Now Leggy Limited had 90,000 equity shares of 100 each, fully paid up. Company decided to buy back 10% of its shares. Okay. So 9,000 into 10%. Sorry, 90,000 into 10%. 90,000 into 10% are to be bought back. So 9,000 shares we have to buy back. Okay. At par. Okay, so rupees 9 lakhs amount required. At par by issue of sufficient number of preference shares. Company do not have any reserves. How many preference shares they are supposed to issue if new preference shares are to be issued at rupees 10 each? Now this is the amount I require for buyback. There is nothing there in my reserves. I have to do completely a fresh issue. How many shares I'll have to issue fresh? Okay. So what is the issue price of the preference shares? Rupees 10. Issued price is rupees 10. So this amount required for buyback divided by the issue price of the fresh issue. So 9 lakhs divided by 10, that will come to 90,000. Say suppose they would have given you issued price is, face value is 10. Issued price is 12. You will do it by 12. Divide by issue price because they don't have only anything. They don't have sufficient funds at all. Okay. So 90,000. That's it. Okay, so question number 1, question number 2. There are hardly any questions as such asked for buyback in solving sections. Okay, all the sums are more. In fact, all the questions of buyback are from Company Act 2013. So please do read the basic provisions which are there of the buyback from your module or from whichever book which you are referring to, and see that you know all the past exam questions. At least for these three, chapter number 3, you all should know everything. Tomorrow we are also going to continue with the other parts which are yet there. I hope you have found my this entire session very useful. Your entire revision is done here with me. Thank you so much for being there. See you all again soon, and do not forget to subscribe to our channel. Also, do join our WhatsApp and Telegram groups. We can keep you updated and posted with all these type of timings, lectures which we keep coming with. Okay, so you all can join our groups, our social media groups, and stay connected with us. See you soon. Bye bye. Yeah.